Hey everyone, and welcome to This Explainer. I am absolutely thrilled you're here today because we are going to unpack something that impacts you literally every single day. Think about it for a second. Every time you buy a packet of biscuits, pay for a food delivery order, or, hire a brilliant freelance graphic designer, there is a hidden transaction happening completely silently in the background of the Indian economy.
So let me ask you something. What exactly is happening silently in the background of every single transaction? Now, if you're just a regular consumer, it probably just looks like a few extra numbers tacked onto the bottom of your bill, right? But if you're a freelancer, an independent contractor, or a small business owner who's earning money from clients, misunderstanding this unseen mechanic is honestly pretty dangerous. It leads to fast-adding penalties, scary legal notices, and blocked credits that will eat directly into your hard-earned profits.
The answer, of course, is GST, the Goods and Services Tax. Look, I know, taxes can sound incredibly intimidating, but I promise you, by the end of our time together today, we are going to demystify this massive topic completely. We're going to do it clearly, we're ditching the confusing financial jargon, and we'll even walk through a real-world example so you can see exactly how it impacts your own bank account. Okay, let's dive into this. Here is our roadmap for today. We'll hit the basics of GST, how the supply chain works, mastering input tax credit, when you actually must register, a real-world freelance example, and we'll finish up by busting some common GST myths. All right, let's kick things off with Section 1, the basics of GST. So, what is this massive economic reform, really? Well, before July 1st, 2017, India had a completely chaotic, fragmented patchwork of taxes. We're talking central excise duty, service tax, VAT, octroi. It was genuinely a nightmare for businesses trying to operate across state lines. But post-2017, we got a solution. One unified consumption tax. It's built on CGST for the central government, SGST for the state government, and IGST for transactions crossing state borders. But hey, the fundamental rule you need to remember here is that GST is a consumption tax. Ultimately, the end consumer is the one who bears the final cost. Now, it's not just one flat rate for everything across the board. You've got 5 specific tax slabs. 0% keeps your daily essentials, like fresh vegetables and healthcare, affordable. Then it scales up. 5% for packaged food, 12% for things like phones, all the way up to a hefty 28% for luxury goods. But as a freelancer, focus on that 18% bracket. That is the standard rate for services. So if you are a freelance designer, an IT developer, or consultant, 18% is your magic number. If you charge a client 100,000 rupees, you add 18% and invoice them 118,000. That extra 18,000 isn't your revenue, though. It's a liability you're just collecting on behalf of the government.
Let's move to Section 2 and see how this builds, how the supply chain works.
So how does that money actually make its way from the creator down to the consumer? Well, this perfectly explains why GST is called a value-added tax. Imagine a manufacturer who pays 18 rupees in GST. Next, the wholesaler adds value and owes 27 rupees, but they claim back the 18 already paid, meaning they only remit 9 rupees. The retailer does the exact same thing, paying only 9 rupees. And the consumer? The consumer bears the final 36 rupees total, which perfectly matches 18% of the final price. Every business in the chain only pays tax on the specific value they added. It completely wipes out the old problem of a cascading tax on tax. It's a pretty brilliant system, actually. Which naturally brings us to Section 3, Mastering Input Tax Credit. Okay, this is absolutely the most exciting part for your wallet. It's the secret weapon of GST for freelancers, the Input Tax Credit, or ITC. Think of ITC as your very own built-in tax reducer. If you are GST registered, the GST you pay on your legitimate business purchases can actually be subtracted from the GST you collect from your clients. So say you buy a high-end laptop for work and pay 18,000 rupees in GST for it. You can literally deduct that exact 18,000 rupees from the GST you owe the government from your freelance sales. The golden rule here, though, it has to be strictly for business use. Personal purchases absolutely do not count, so you've got to keep that line between business and personal completely clean. All right, Section 4, when you must register. Now, you might be wondering, when do I actually have to get involved in all this? Here is the magic number. 20 lakhs, or 2 million rupees in annual turnover. If you're a service provider, which includes almost all freelancers, and your annual billing crosses this threshold, GST registration becomes legally mandatory, period, no exceptions.
Now, if you're below 20 lakhs, it's totally optional. But listen, if your clients are registered businesses, they might actually want you to be registered so they can claim that sweet input tax credit on your invoices. In that scenario, voluntary registration is a super smart commercial move.
Once you do decide to register on the government portal, you're going to see two main paths, the regular scheme and the composition scheme. The regular scheme involves collecting that 18% tax and, crucially, allows you to claim your ITC. Honestly, this is the right choice for almost all service providers and freelancers. The composition scheme, on the other hand, gives you a flat 1 to 6% rate, but you cannot claim ITC, and it comes with heavy restrictions. In fact, service providers earning over 50 lakhs can't even use it. So stick to the regular scheme to really maximize those benefits. Let's make this totally concrete in Section 5, a real-world example of a freelance designer.
Because abstract percentages can be kind of hard to visualize, let's ground this. Meet Kavya. She's a freelance UI designer based in Bangalore. In her first quarter, she invoiced her clients and collected 63,000 rupees in GST. That is her output tax. But remember ITC. During that very same quarter, Kavya bought a work laptop, an Adobe Creative Cloud subscription, and a new office desk. The GST she paid on those business expenses came out to exactly 18,000 rupees. So she simply takes her 63,000 rupees collected, subtracts her 18,000 rupees of ITC, and boom, her net payable to the government is only 45,000 rupees. She pays that, files her GSTR1 and her GSTR3B summary, and she's done. It's clean, it's logical, and most importantly, it saves her money.
Wrapping up with Section 6, busting common GST myths. Even with clear examples like Kavya's, I know fears still persist. So let's dismantle these rapid fire. Myth number 1. If I add 18% GST to my invoices, my clients will think I'm way too expensive. The truth? If you're working with other businesses, B2B clients, they claim your GST right back as input tax credit. It literally costs them absolutely nothing extra. And honestly, having a GST identification number signals real corporate professionalism. It can actually help you land those bigger clients. Okay, myth number 2. My turnover is under 20 lakhs, so I don't have to worry about GST at all, right? Well, the truth is a bit more nuanced. While it generally is optional below that threshold, if you have clients outside of India, you are officially exporting services. Exports trigger very specific special rules, and you might find that registration is mandatory regardless of how much you're earning. Always double-check your specific cross-border situation. And finally, myth number 3. Filing GST returns is just way too complicated. I'll just ignore it for now. The truth here is absolutely critical, guys. Once you register, filing is a strict legal obligation. Even if you made zero income one month, you still have to file what's called a nil return. Ignoring it, that triggers a 50 rupee per day late fee, plus interest. But the great news is that software like Zoho Books or ClearTax automates almost all of this for you, or a CA can handle it super cheaply. The cost of compliance is tiny compared to the heavy cost of ignoring it. So the crucial point is really captured right here in these big takeaways. GST is a unified tax that thankfully replaced the old chaotic system. 18% is your standard rate as a service provider. The end consumer ultimately bears the full cost of the tax. Use input tax credit to legally reduce your tax bill through your legitimate business purchases. Keep in mind that registration is strictly mandatory once you cross 20 lakhs. And please remember that filing returns, yes, even nil returns, is legally required once you're in the system. Now that you have GST totally demystified and working in your favor, what is next? Are you ready to master advanced tax? If you've ever been hit with a surprise interest notice for unpaid advanced tax, trust me, you won't want to miss our next explainer. Make sure you subscribe so you're the first to get it, share this explainer with a fellow freelancer who really needs to hear this, and keep learning. I'll see you in the next one.